Good evening, everyone. I'm Steve Ankerstar, and welcome to the Ankerstar Wealth Investment Advisory Brief, the first one of 23. And during this briefing, we are going to talk about what happened in 2022 and our plan for 2023 and my forecast even beyond that. So those are going to be the primary topics. I will give you a look inside the portfolio, at least at our top 10 holdings, not all of it. I'll talk to the models that we're using as part of the core and satellite approach to take care of our investors out there and how we use a risk-aligned portfolio process to do that. And I will also talk about some major investment themes that I see working down the road. At the end, though, I will be taking your questions, which I've had very few of these in the past, but if you would, we have a new format now. We're actually on a Zoom call versus the one we had previously where you had a Q&A window. So if you have any questions, please put them in the chat window, and I will generally address them at the end in case I see something that pops up that needs to be addressed right away. But let me introduce our investment advisory board. We have myself and, of course, the other three advisors that are there below as part of the Ankerstar Wealth team. And then we have three of our major investors that have lent us their expertise. They're not advisors, but they lend their expertise to us to kind of help focus, giving us that outside in approach to be able to help us do business better and give us feedback from their experience. So with that, let's go ahead and get started with the disclaimer, though. A lot of words, as they always are. So if you're catching this on recording, you'll have to pause and kind of read through it. But the biggest part of this to understand is that these projections are my projections based on the inputs from the team as to what I think is going to happen and how we're going to position your portfolios for success. Obviously, I do not have a crystal ball. None of us does. So therefore, there's going to be some leeway in what I'm going to get right and what I'm going to get wrong. But that's what this covers. And they are all forward-looking statements, and you can read that later, or I can provide it to you if you'd like to see the full disclosure. Okay, let's start with what we are all about. First of all, there's the team. Super proud of the team that we've assembled. As you know, if you've been with Ankerstar Wealth for a while, it was me for a long time. So last year, we brought Candace on board to kind of anchor the operation and do a lot of the behind the scenes stuff that needed to be done, as well as build out the rest of the team. Jaden's been with us for now 3 years, starting as an intern, now a full-fledged advisor, and then everybody else is helping out in their particular roles. So when you move from 1 to 6 people in the course of an 18-month period, there's lots of growing pains. There's a lot of things you don't see the behind the scenes that the team is building out, to help serve you better. So, and a lot of internal training to go on to kind of get everybody up to speed and get everybody on the same page. So super proud of the team. I did want to put these words up there specifically. This was our Happy New Year greeting. If you happen to see it in the email there. The past year was the most challenging year for investing really since 2008, which is quite a statement, right? Because that's what 14 years ago. So I simply chose in over a decade. Whenever you have challenge, any team that has a challenging year that's when you find out who people really are. And when I look at building out the team and helping clients, I first of all look for optimists. I think in the finance industry you have to be an optimist or it just doesn't work. And then I'm looking for workers. I'm looking for problem solvers, and lastly, the focus on the people versus the money. I do have folks that I speak a lot at career events and things where kids are like, hey, I want to get in the finance business for the money. It's just like, well, you need to get it into you need to get in the business for the people, not the money, right? Otherwise you won't be in the business very long. So that's what I look for. So super proud of the team there. I thank you, the client. What do you have to do? You have to believe. I was trying to find the Ted Lasso graphic, of the believe above the locker room door there. But really, you do have to believe in us, have confidence in us. And whenever there are tough conversations that need to be had, I generally say 2 things to a client. I'm like, well, you've either lost confidence in your investments or you lost confidence in us. If you've lost confidence in your investments, we find you some new investments, right? If it's us, then we need to transition you to somebody else who can help serve you better. So that's what we bring to you. So you have to believe in us. So thank you for your trust, patience, and friendship as we navigate this journey together. And I will talk a little bit more about the journey towards the end, because really investing is a 10, 20, 30, 40, 50-year journey. If you're on for your first year of the journey, you've had a terrible experience. However, if you've been 25 years into this journey, you're like, yep, another rainstorm in paradise, no big deal. So obviously that can really affect your emotions at the time. And then lastly, here's to you and your family having an amazing 2023, because that's what money is about. It's not a number that you're trying to accumulate. It's an enabler for you to be able to go out and take care of you and your family and have a great life experience, right? So at the bottom, in parentheses, or excuse me, in italics there, rapid response to client concerns. That's ultimately what we're trying to do, is get you an answer either right away if we know the answer, or much like, doctors, lawyers, whatever, it's like you ask us a hard question and it's going to take a while for us to find the answer, but we're trying to get back to you within 24 hours. And then that's step one, is answer your questions. And two is to maximize your returns in line with your risk tolerance and number. And that's why I put, that those are fancy words, but really, if you go over to the green square there, I tried to put this in the 8th grade reading level, which is why I like reading the USA Today and going to Investopedia, because it's written with smaller words that are easier to understand. But really, we're trying to make as much money possible within that risk tolerance we identified in your contract. Through volatile times, we're going to try to coach and mentor you through those to avoid making mistakes. And if you insist on what we would consider a financial mistake, we're just trying to mitigate the damage of that, whether that be locking in losses or
Step under
somebody needs to go on mute there. Or mitigate the damage of those particular mistakes. So stand by for just 1 second here. All right, there we go. Everybody's back on mute. Thank you. All right, so that's the big picture. Let's take a look at the book. The end of the year, assets under management, AUA total was 51 million. We started just below 49 million of the year. So overall, the book has grown. So whenever I say that, I can picture, if I could see all of you, I would see the grimace of, well, my account hasn't grown. And that's true. Very few accounts are up, and the only ones that are up were in alternative investments almost entirely. Because really, that's about the only thing that worked this past year. Everything was down, from stocks, bonds, even CDs if you bought them, gold, crypto, whatever you were in. If it was market related, it basically sold off. So those are the tough years, and we'll talk more about that in a second. True assets under management, you can see the AUM, AUA, alternatives, and cash in the left-hand column. Going to the middle column, however, you can see that our cash position, the 5th one down there, we were almost 10% cash at the beginning of the last quarter, and we've deployed a lot of that in this quarter. And what we've come up with there is we found a lot of shorter term type investments that are generating that 4 and 5%, but don't have the full exposure to the market like an investment grade bond does. So really, the team is focused in this past quarter on finding those things that are able to generate some return to try to combat inflation. And so we moved that cash out of there and on into mostly ETFs, is what you can see is up at 10%. JPST, you'll hear more about that, or you may have seen that in your portfolio. That's the JP Morgan short-term fund that incorporates treasury bonds and CDs and a lot of paper that is generating a higher yield now that interest rates are up, that we haven't had available to us before this past quarter. So that's most of the changes in here, and you may have seen that reflected in your portfolio. Lastly, the alternate investments off to the side. If you're with the Blackstone Group, BCRED and BREIT have been superstars. BCRED pays out 8%, and it pays that out annually, but it pays on a monthly basis. So it's a nice chunk of change coming in if you have a sizable position. And then BREIT is targeted at paying out that 6%. So again, pays out a little bit less, but a little more stable because it's backed by physical real estate. So those are both things to consider. If you don't have those in your portfolios and you're interested, it's nice, what I would call ballast to have in your portfolio. The downside to it is when you put your money in, it's considered as an enduring investment, meaning that you should hold it for a long time. We're not talking a year. We're talking 5 to 10 years. They're kind of, if you will, fire and forget type of investments, to where you let the professionals sit there and just generate that return. I mean, if you're building wealth, you can reinvest the returns and get more shares, or if you're there for the income, I like taking the cash out of it, a couple $1,000 a month rolling in and just sheer cash, getting kicked off of these things are pretty nice, whether you're in retirement or you're looking to take that cash and use it elsewhere or consume it. Other things at the bottom, I'm not going to talk to you specifically, but if you do want exposure outside of the traditional market, then just go ahead and ask me, and I have some solutions for you. I should say the team has solutions for you. Any of us can help put you into those sorts of things. All right, the top 10 holdings, which you see listed here, and then you see the change off to the right in parentheses if there is a change. Apple's the top holding. I do get the question, when your top holding is hitting a 52-week low, that's not fun. But part of the bear market strategy of flock to quality and basically hold the quality names through, I'm buying more Apple here. It's down below $130. It was up at almost 180. Yeah, no problem buying more here. A lot of us have a lot of it, so therefore it's not exactly smart for you to load up necessarily, because you might be oversized already. However, if you don't have it, or if you have a little bit of it, you'll see a few shares here and there pop into your portfolio. Absolutely no concerns with 3 of the top 4 there: Apple, Google, or Amazon, as far as the individual stocks that we're holding. Buffer is a ETF of ETFs, if you will, which is based almost entirely from options, so very difficult to understand. However, what it does is it mitigates the volatility of the overall S&P 500 is probably the best way to explain it. What it's the function it performs in your portfolio is ballast, if you will, right? It just reduces volatility. That is when people say, well, what's going to happen when we get back more aggressive? Well, buffer, I'm going to sell all of it, right? Because we don't need it in a down market. If once things flip to the upside and I get some confidence that it's going to stay moving up. We've had short-term spurts up and people are like, hey, you ready to sell buffer? I'm like, absolutely not. I want to know the bottom is in when buffer pops up. All right. The next one there, First Trust Tactical High Yield Fund. You'll see 4, 5 if you include the bottom one, First Trust Holdings. Again, very smart people. Brian Westbury's their chief economist. I believe him to a T on what stuff's going to happen. And largely I base a lot of my investing off of what he is saying. And these specific funds, high yield pays out, I can't remember the exact percentage, but it pays out monthly. So it's a lot of these, in times where the stock market is selling off or the bond market is selling off, it's nice to have these income producers just sitting there kicking off income every month, like BCRED, BREIT, and even Buffer pays off a monthly. The next two, they're BCRED. We talked about moving up the highest on the list of people going in there. Blackstone was in the news for BREIT for not being able to meet the redemptions, because a lot of people tried to cash in at this past quarter. Well, the University of California just put $4 billion more into BREIT. So I mean, it's the private investors that are a bit emotional and not thinking long term, or the ones that are selling out of that fund. The institutional investors are not. Again, they're holding it for decades, basically. All right, we have cybersecurity and cloud computing. One of my two of my favorite themes that are out there. And again, most of you have exposure to this unless you're in a super conservative portfolio. The JP Morgan ultra short income, that's that JPST holding. That's kind of a cash equivalent. That's another thing that will go away once the market goes to now a traditional path. And we'll look at a chart here a little bit later is what I'm talking about. And then King, KNG, which is the dividend aristocrats. Those are the, boring, cheese and diapers companies that are in energy that are, they're also selling off, but they're kicking off these huge dividends along the way. So it's nice to be able to have that cash to either reinvest low while prices are low, or move to some of these other secure things while we're waiting for the move back higher. As far as the last one, opportunistic fixed income, this is more of a risk on fixed income where they're looking into some lower level credit rating stuff, kind of in the junk area. So we've reduced our holdings significantly in that portfolio, or that index fund, because of the losses it was taken. It's just like, let's move to safety in the bond world as well. Okay, so the question becomes, what are the investment themes? Well, first of all, you look at this slide and it's all red. Well, it's a scorecard. That's it. This is looking backwards at 2022. What worked? Well, not much. Hardly anything worked. And then, gold didn't work. Crypto didn't work. Commodities, some ran up, some did not. They're more speculation than anything. But as far as traditional, like 60-40 portfolio, both sides were down, right? So the things in green, we've already talked about: private equity, secured lending, and, credit. Other than that, it was in the red. How much in the red? Depending on if it was more towards technology, it would be more in the red. And if it was more towards the, core Dow components, then it's not quite as red. But basically red across the board. So, when you think of how do you deal with that? Well, early in 2022, we went to quality, and then we're basically holding through. That can be painful. We're going to talk about the emotional side of it here in a minute. However, let's look at the starting lineup for 2023. And, I talked to some folks about portfolio management, and I say it's exactly like coaching. What you're doing is you are, whether it's a coaching an actual team or like fantasy football teams, right? It's the same thing. You're looking at all the assets you have available to you, and you're putting the best lineup together at the different positions. So you have some diversification, but the best you can find. And as a portfolio manager, I basically have the whole universe of investments available to me. So, BCRED and BREIT are still going to be kind of the big, the major holdings, if you will, for those that are in those. We're going to keep buffering here until I'm sure that the kind of the pain in the market is over. When will that occur? Basically, when the Fed stops raising rates. So when the Fed pauses, or when the Fed slows down or forecasts that they're going to slow down, you'll see the market react due to that higher. However, I'm not really going to leave out of buffer until it's actually established higher. So I'll take more risk in other names, but the move out of buffer will be the kind of the all clear signal, which we certainly haven't had yet, even though we've had those bumps up, right? JEPI and JEPQ, you'll see in your portfolios, those are enhanced income. Those are stocks with largely options around them. They're kicking off income. So they do still move up and down, but not as much because they're buffered by the options and they generate income. So we're staying in that at least until the market turns back higher and we can focus back on individual names. For the dividend index funds, again, staying in those. Our two themes are rock solid in cybersecurity and cloud computing. The best of breed names, we're staying in Apple, Amazon, and Google. If you do see a share or two move of that's just some readjustment in your portfolio or risk management. That's not saying that those aren't the future, because they are. New or increased positions that you may see is ServiceNow, which is ticker NOW. I like the name. It's a workplace integration, being able to do everything for large firms. So again, I think it's for a tech name, it's about as safe as you can get. And it's down big. So if you look at the chart, you're going to be like, well, that doesn't look safe to me. And I'm like, well, it looks safe from where it is now. Get it now. But it's had a rough year. So I like the entry point here. Blackstone and Blackstone Secure Lending. Again, if you have that, you may have plussed up. We adjusted some of our models, the percentages of them there to reflect that. Next up, once things turn, which I do think happens in 2023, and we'll see that in a minute, financials, I think, are all going to benefit from the increase in rates until the rates get lowered, which maybe next year, maybe, it'd be never if you listen to the Fed, right? Because they're going to find that perfect spot where we pause and we never have to touch interest rates again, right? I don't see that happening. That's about the only thing I think won't happen is we'll successfully pause at the perfect level. That's just not how life works. Back into tech. And then for those that have stomach, obviously the stomach for it, investing in China. Investing is about making money. So regardless of your individual thoughts on China, we're trying to look for the biggest opportunity out there in China. Now that they've, decreased their COVID restrictions, starting to open up their economy a little bit. A lot of those stocks have already started moving back higher. I'm not ready to go there until the overall U.S. market starts going back higher. So I'm willing to forego that initial gain or the continued gains, but piggybacking on it later. Okay. Here's the forecast. Again, the four people you see pictured are Jamie Dimon, CEO, JP Morgan. Upper right is our Fed chairman, Jay Powell. Lower right's Joe Zeidel from Blackstone. And then lower left is Brian Westbury from First Trust. Again, when you're in this business, it's listen to the people that are smarter than you, take what they're saying and what you like, keep what you like out of it, consider, but then ultimately, get rid of the rest and then form your own opinion, right? So that's where we are. Reviewing 2022, we had inflation, we had interest rates were the cure for inflation. We didn't know if the cure would be worse than the disease. Did we hit a recession? I don't know. The government says no. I think history will say yes. We'll let other people other than us sort that out. The election that we had, the midterm, was really not much as far as the market. You may have been affected personally or emotionally with what did or didn't happen to you in the election, but overall, it stabilized the government by splitting the government. And then it wasn't really dramatic either way, if you will. Ukraine-Russia conflict, again, not much change there. Inflation, the course of the year was stickier than we thought. Largely that's due to the math of it being a 12-month roll moving average sort of thing. So There's that portion of it, but it is starting to decrease, and that will obviously continue. We did have the four in a row 75 basis point rate hikes. I think if you tell anybody that that would happen in 1 year consecutively, they would think the market would be down 50%, right? So we really kind of weathered that storm of being able to raise rates fairly quickly with a big but not a huge hit to the overall market. And then we had retracements in there, which were kind of those false, bear market bounce, if you will, bear market rallies, but really ended up continuing selling back off and retracing back both times. All right, specifically last quarter, we did have the rate hikes decrease from 75 to 50. So we had a 50 basis point rate hike. And then of course, the projection for the first quarter of 23 will be that is a 25 basis point rate hike. We'll see. When we did that, Chairman Powell said there's gonna be more pain ahead. So it's like, just when you give us the good news, you have to ruin it by saying there's gonna be more pain ahead. He's just trying to navigate this the best he can. Overall, I think the Fed's doing a fantastic job of, really forecasting what they're doing. Whether you agree with it or not, or think it's necessary or not, is irrelevant. They've been kind of staying on the path that they said we were going to go on, which is nice because the market feels they can kind of trust what they're saying. On into the forecast, I think we see 1 to 2 more rate hikes. I think that's the likely scenario. The next likely would be 3 or 4. Either way, 2023 is going to be the year that we pick where that top is and pause. I don't see us continuing into 24 with rate hikes. So that's my call. I think that's the common call. The only real argument is whether is it going to happen earlier or later in the year. I think it'll happen earlier, is my opinion. I do think whatever rates we stop at is going to be higher than we actually needed. So it's going to overshoot to the upside. Many of you know my favorite leadership phrase, which I heard on the military, was why simply react when you have the time and energy to overreact. So I think that parlays into the Fed is going to do not just enough to kill off inflation. They're going to do more than enough to kill off inflation. So I'm not throwing a spear at them. I'm just saying they're going to do too much, right? To make sure the thing's dead and it's not a problem anymore, and then deal with the subsequent problems of the rate hikes. How do you deal with that? You lower them. Right. So I do think we're going to be in an overshoot to the upside. We'll wait and see once we're there, and we'll reassess. But in 2023, the worst case scenario, and this is the one that Mr. Zeidel threw out late last year, is what if the rate hikes don't slow inflation? That is a bad scenario. If that happens, everything kind of needs to be addressed. So when you look at the military planning model, when you think of the 5 different scenarios, things are really good or pretty good or average or pretty bad or really bad. That's the really bad scenario. So you have to acknowledge it could happen. So that's why everybody's kind of hanging on to every inflation number that's out there. However, on into the 3 to what is it, 1 to 4 year future there. 24 to 26. I do think it'll look a lot like 2007 and 2009. There's lots of charts, and you can put any chart over another one and try to make your case. And I've seen some people send me some things going, this looks just like 2008, and there's another 20 to 30% to the downside. And I'm like, well, the financial infrastructure isn't broken. It was broken then, right? We just have inflation now. You could argue why we have it. We're not going to get into that, but we do have it. So we just need to fix it. So that's what we're looking at. I do think that once it's over, whenever that is, you're going to see a huge snapback, right? And the market is predictive. So therefore, when the market thinks it's over, that's when the move is, which is the number one reason for not just going to cash and waiting, is because that move up is going to be huge. And we saw that coming out of January of 2020, we saw that. And then we saw it again in March of 2020. We saw it in January 19, a huge move up. And then we saw the snapback out of the COVID situation. So when these things move, they move back up. So you just don't want to miss that. That's a lot of return to leave on the table. So as far as the decade summary, get out of your mind that we lived on a 20% per year kind of return, and based our forecasts and projections of wealth on that. Traditional returns are more than likely 10 to 12, and maybe even 8 to 10. I still am an optimist, so I'm probably saying 10 to 12 because we're largely tech focused. But I could support 8 to 10 if somebody wanted to challenge my number out there. Again, I think outperformance is going to be focused on a few firms. That's why we're picking individual names and just not buying the overall index. We will load in, but get back into some more speculative investments as the market recovers. We're not talking crypto, but certainly broadening the portfolio into individual names that we can believe in and trust. Again, not just that have the underlying company that's good, as well as the leadership team in place for that. Okay. And then the snapback. We don't know when the snapback is. That'd be easy if you knew. We just simply don't. So that's why we stay largely invested through this. Okay. We are in a bear market strategy. We were in it in 2022, almost the whole year. We're still in it. That can wear on you. It really can. I get it. Especially when you start 2023 and the first day is down, second day starts up and then goes back down. The third day is just down. So we've had 3 days kind of in a row that are down, and I've gotten more emails and texts and everything about, hey, is this another year of this crap? Right. Well, that's why I put together this brief, because there will be more pain before gain. I do believe that. And it's going to test you. And when the market professionals talk about, when is investing easy? And, I'll pat myself on the back. I had a heck of a run navigating the sell-off in 2020 when I, gave the lock and load video out on March 23rd of 2020, is when the market overreacts significantly to the downside, it's easy. You simply load up. And so are we there? No. But if we have a mass capitulation, which we may see if we continue down, day after day after day into 2023, there are going to be a lot of people that just bail. They leave the market, and they're probably leaving it for life, to be honest. It's so hard to get back in if you just leave it and then watch the market reverse on you. But when you say a market capitulation, say we have a 10% down month in January of 2023, from a professional investor standpoint, that's great news, because now the pain is over, right? Because you can find the bottom. When we kind of bebop around in the middle ground, which we did 2023, it's really tough to be able to tell whether it's going to go up or down tomorrow, let alone in a week or month. But if you have that huge capitulation, then that is the number one signal that the bottom is now in, and you can get back into the investing. If you have any more questions on this, you reach out or pause it on the video, and you can take a look at it. Okay, what I'll close with here is the risk aligned portfolios. I still say it's kind of new. It's not new that we've been doing it. We've been doing it for years. It's new that our explaining it to you and getting you kind of understand of what we're talking about when we pull out the contracts once a year and say, hey, let's talk risk number and risk alignment and sort of stuff. A lot of people are like, okay, sure, whatever you say. Well, we kind of want you to have a little better understanding of what that means. That's why I want to talk to it for just a few minutes. We have made some adjustments to not only within our models, but the total number of models. We reduced those. You can see we have 9 models that we're using. We use a core and satellite approach. So largely your portfolio is in a model, and then you have some satellite holdings. Some of you have been with our firm for a long time, just have individual holdings that's not tied to a model. So all this is to benefit you and the overall number, to be able to help us serve you and make as much money as we can along this journey. But that's why I say manage your journey, right? If you're in a conservative journey where you have a risk number of say 33 or 25, that is largely a fixed income portfolio. You can do that through your whole life and average, 4 to 5% and be just perfectly happy. So I'm not trying to tell you to take more risk, and nobody should try to convince you of it. If that's the path you want, that's a lot safer path than if you go the other extreme, which is the bottom right, the highly aggressive. The overall market is around a 77 risk. So any of those 3 columns to the right, when the market sells off, you are going to be down more than the market. Now, I would like to say that we have expertise on board and that we've done a great job of mitigating your losses, so you're actually not down more than the market. But conceptually, if you're off in aggressive land, you should be mentally prepared to lose more than the market. And again, by using buffer and king and some CDs thrown in there, we're mitigating that downside. But that's our tactical job, not your strategic job. Your strategic job is think of where you lie within this and go from there. Now, what I will tell you is the bottom right there is, mitigate the damage of making financial mistakes. So what do you mean? Well, you need to pick a strategy and stick with it in investing. You really do. And I have conversations all this time, a lot of times of, hey, why don't we switch from this to this to this to this to this? And it's just like, If you pick any of these, you'll be fine. If you keep switching back and forth, that's where, the conservative model will be successful. The highly aggressive model will be successful. May have rough ride of the bit, but you ultimately it'll be successful. Where you run the risk is if you keep hopping from one to the other, and that's the timing of the market, right? And you're like, well, that's not timing. Well, yes, it is, because you're switching strategies along the way. And to give you one quick flying scenario is when you're rolling down the runway on a takeoff and something happens. Say you have an engine fire. You can make a decision to go or stop. And we joke in the pilot world is that, there's a perfect number, right? You can calculate it and say, okay, at this exact airspeed, if you're slower than that, you should stop. And if you're above that, then you should go. But that's theory. In reality, you make a decision, and as long as you make a decision and stick with it, you're probably going to be fine. So if you blow off the number, you forget it, or you're nervous or distracted or whatever, you can stop above that number or you can go below that number. And as long as you execute it and stick with it, you're probably going to be fine. The people that get killed are the ones that switch. They go, no, stop, or stop. Oh, crap, I should have gone. And, so that's what we're looking at in investing. That's why you don't, if you entered 2023 and you're in a highly aggressive model and you have been for the past year, you need to stick with the model, right? So let me show you this next slide. It looks like three different charts. They're not. They're the same chart over three different time frames. So we'll start over on the left side. That's the 1 year time frame. If that's your investing experience is 1 year, you are down money. Period. Dot. You and everybody else that's been on the team for a year, on the investing team, not just the Ankerstar Wealth team, but all the people. So that's been your experience. If you move that to 5 years, you go, okay, well, we're all up. If you've been 5 years and you've averaged, whatever that would happen to be for the S&P 500 over that time. And then of course, this is a 25-year chart off to the right, then you have no problem whatsoever. And you've seen, if you have that much experience, you're like, look, I've seen these sell-offs. They're always terrible when you're in them, but when they recover, they snap back pretty quick. And you want to make sure you get all that gain to the upside. And the snapback lasts longer than the heart attack, right? So it's truly like rain in paradise. It happens. It can be brutal. It can tear stuff up. But you know what? When the sun comes back out, you clean up the mess and it goes back to being paradise again. That is the investing experience. But the predictability of it is even more difficult than predicting the weather. And you've seen how that works, right? So I want to talk about that switching strategy. So the most common, if you go to the middle chart with me and you just use the COVID scenario, if you're an aggressive investor or, anywhere in the moderately or aggressive investor, and you're tooling along there to the beginning of March in 2020 and the market sells off, well, if you locked in the full loss by selling, by switching to a conservative strategy after the market's down 20, 30, 35%, you have locked in those losses. And then it will take you, in this example, it took like 2 months for you to make all that 35% back. That's not going to happen very often. But it would take a conservative investor, if you switch to your conservative approach, because you couldn't lose one more penny. That's an exact quote I got from a client, now former client. If you switch strategies that conservative, then it's going to take you a decade, when the only mistake that was made is you switch strategies, right? So that's why we want to lead with that, with the, hey, let's talk about our lifelong journey here and kind of get into one of these buckets. And then that way we can mitigate the best we can. So that's your strategic guidance or a strategic agreement. And then we use our tactical expertise to get in there and mitigate a little bit less, mitigate the downside when the market's on the way down, but also now look for that alpha when the market's back up, which, we do because we're heavily invested in technology. So just want to throw that out there for some consumption, if you will. Reach out to one of the advisors on the team, whoever's working with you directly, and they can answer your question. So, okay, a lot of me talking there for 34 minutes. So I'm going to have another drink of water. I don't have any questions sitting right there. So I'll pause for just a second. If you can think of one, please throw it in there. Otherwise, we will conclude. All right. Thank you so much for listening. Again, I see some of the names that are popped up. A few of you have appointments with here soon. So if you have questions, just remember them, put them in your notes. And then once we meet and talk, we will address those. But again, to summarize, rough year in 2022. Thanks for hanging in there with us. The bear market strategy is never fun, But 2023, there's going to be pain and then gain, is my opinion. So don't expect it to switch tomorrow. But certainly once the Fed stops raising rates or slightly before that, then that's when you're going to see your market turn higher. And that's when you can start looking back at your portfolio again and seeing the numbers get bigger versus smaller. So with that, I'll go ahead and conclude. Thanks again for listening in, and we will see you next time. Bye.